Now, our next panel is an interesting topic. In a minute, I'm going to call on stage Lily and Diogo. Lily is the president at the Solana Foundation. And Diogo is with the founder of Anchorage and currently also involved with Haun Ventures. And the name of the fireside chat is being both an operator and an investor. And I often find that we get into that situation a lot where indeed it's kind of like it's a friction point. So I'm curious to hear from what angle they're going to take this. And again, promise me, hands up, ask him the hardest questions. All right? Thanks so much. Lily, Diogo, stage is yours. Thanks so much, mate. Thank you.
Hello, everyone. Welcome to our panel. Lily is one of my favorite people, so I was very excited when she invited me to a fireside chat. So that's pretty amazing. And I'm glad they didn't actually swap our pictures.
Yeah, I don't think people are going to confuse us.
That's amazing. So maybe first and foremost, we'll start with quick intros. Lily decided that she was going to introduce me, and I was going to introduce her. And so I will start by handing you the stage.
Sure. So Diogo, good friend of mine, we first met in 2017 in San Francisco over sushi, really. And I quickly realized what a cool guy Diogo is, and apparently he's done some things in life as well. Originally is a PhD from Portugal who I think was featured in a hackathon and then ended up moving to the Bay Area. He was an early employee at Square, where he met his co-founder of Anchorage Digital, named Nathan, and they are on the patent for the first encrypted credit card reader. He went on to lead security at Docker, that now secures billions of servers on the internet. And he and Nathan founded Anchorage Digital in 2017, federally chartered bank in the US, the only one when it comes to crypto. They have one of the slickest products, in my opinion. I've been a user for many years. And he recently became a GP at Haun Ventures. And he's also still the executive chairman of Anchorage Digital. He's also the chairman at Near Foundation, so father of two, right?
That's right.
And so engineer became founder, who now allocates capital.
And Lily, we've, as you mentioned, met in, I think it was either 2017 or 2016. It was the time where San Francisco was just full of real crypto folks just getting together and talking a little bit about it, and it was not very commercial at all. And Lily was always the smartest person in the room, which was what drew me to her. She is incredible. I think if you know of her career, most recently in crypto, she actually sold Earn.com to Coinbase. Then she went on to found Anagram. We're going to talk a little bit about it, but it's a really interesting model of operations and venture simultaneously. So the same way that I say that I'm an engineer that allocates capital, Lily likes to say that it's a holding company that builds, advises, and invests. So that's actually a pretty good tagline. And obviously, she's also on the founding team of Osmosis, which, as you know, is the decentralized exchange for Cosmos, and is also the president of the Solana Foundation, where we have a lot of debates whether Near or Solana is the best layer one. Turns out the answer is both. So let's get on with it and not try to find a winner here, because we're not gonna leave. So maybe I'll start with the following. I think there's a real question. The title of the panel is Operator and Investors. Both Lily and I, as you know, have both these hats. So I'm very curious about how being an investor actually makes you a better operator.
Yeah, I think in crypto, we have this tribalism within crypto, and there's a little bit of a conflict between the heart and the head, right? In your heart, you have your alliances, you have the communities that you feel a part of. There's certainly a religious nature about crypto. I think that's all something that's very clear for us to see. But then I think that there is, if you think about this very intellectually, there is a lot of innovation, many good ideas that happen really across the ecosystem. And as an investor, it forces you to think a little bit more with the head and look across the industry, look at macro trends, and think about them very objectively. And what I find to be helpful about that is it helps balance out, your desire for your team, your ecosystem to be number one in all areas, and actually more intellectually be honest and learn from the innovations that are happening across the ecosystem, right? And that's something that I think with the amount of talented people we have here is something that is quite important to do. I also think that when you have to put yourself across the table from where you may be operating, it helps you also just to be much more intellectually honest about what you guys are building, right? How good is it really? How innovative is it really? And to me, I think it really just keeps you honest. And that's something that I feel like is a very important balance. To be, I kind of joke that Solana is all about parallel execution, so parallel executing being an investor and operator, haha, right? So that's one thing for me. I also think many talented builders, they may not come into the ecosystem, in Solana's case, starting with Solana, a little bit more likely today than maybe a few years ago. But as a part of that, having that sort of broader network into who are the best builders and helping attract those people into the ecosystem is something that I find to be very beneficial in my role as an operator.
And there's something that we actually actively debated. So one of the things that have always impressed me about you was your mastery over, let's call it startup fundamentals, company building fundamentals. For those of you that are in crypto, let me just tell you that normal companies have something called revenue. They have something called net retention. They have these normal metrics by which we actually underwrite them, right? We have those things. And obviously, Lily is a master of those types of underwriting. And one of the questions that I have for you is actually, in crypto, and as an investor in crypto, do you have to turn off that part of your brain when you're investing in a token issuance, either a layer 1 or anything that issues a token? Do you have to turn off that part of your brain?
I see them as being totally different animals. I think there are companies in this space, and I think there are protocols in this space. If you think about the terminal endpoint of a company, what it seeks to do is it seeks to consolidate all capital, both human and financial, onto its balance sheet. That is the very definition and life purpose of a company. For a protocol, it's the exact opposite. Your terminal endpoint is to own none of it as whatever the central entity or central core team, core contributors might have started out to be, right? Your terminal endpoint of ultimate success is like Bitcoin. There is no central entity. So therefore, I think that there certainly are quite a number of companies that do hew to traditional metrics. Anchorage, for example, would be one which is closer to that end of the spectrum. And so for me, I feel like that's an early fork in how to think about different opportunities that come your way. Is this an equity company or is this a protocol? And then on top of a protocol, many of the projects are equity companies, right? Because as a layer 1 protocol, you're a little bit more sort of the city, the fallow fields. You attract producers to come and build a business within your city. And so I think that there are still quite a number of opportunities within crypto when the more, let's call it, traditional mindset applies. But then I think you just need to be aware that there's also quite a number of projects and founders and situations where it's an entirely different model that we as an industry, as crypto, are proposing, which is value creation, capture, so on and so forth in a protocol setting versus a company setting.
Okay. That makes tons of sense. And actually, I'm curious. So one of the questions that I asked you was, well, what being an investor makes you better at operator? And I think a curious question is also what being an operator makes you better at investor. And I actually have an opinion here, which is being an operator mostly makes you worse at investing, not better, period. I think the best investors, and by the way, I'm an operator all of my career. I've been an investor for all of 3 weeks. And so I'm telling you this, even though it does not benefit me at all. And part of the reason, well, let me tell you the advantage first. The advantage first is that the narrative is really good. I think right now it's fair to say that there are no crypto, outside of Haun Ventures, there are no crypto funds that actually have a crypto founder as a GP. There are none of them. All of them are just investors. And there is a lot of empathy that a founder has for another founder because they understand that starting a company is every day you wake up and you get punched in the face. That's what it is. And so that empathy actually helps a lot with telling investors, or sorry, telling entrepreneurs that you understand what they're going through. But a question for you is, one of the things that I found myself doing over and over again, and it's one of the biggest disadvantages of being an operator that invests, is that when I'm seeing your pitch, I'm looking at your pitch, and I'm hearing the things that you're saying, but I'm imagining myself in your seat executing them. I am judging you by how I would execute in your shoes your idea. And that's extremely unfair. because I may be better at some things, I may be better, I may be worse at some things. But regardless, I'm not actually judging the CEO in front of me and the team in front of me. I'm judging myself in your shoes, in your context, in your idea, trying to execute it. And I still don't have a good answer. And so my question for you is, how do you not evaluate yourself in the shoes of somebody that you're pitching? How do you turn off this like Lily the operator, especially when you're on a daily basis, constantly doing both and constantly trading hats back and forth? How do you judge for what it is versus for what you could do in their shoes?
I think that what is helpful is the role in which I am an operator at Solana, which is at a certain stage of growth. It's very different from where almost all of the kind of seed stage operators you're going to be speaking to are, right? So in that sense, it's there isn't a lot of opportunity to mirror because they're just so different. And so I think that I think it's actually quite easy to empathize and really sort of think back to be in the same seats rather than to mirror sort of what the current realities are, because they are quite different, right? Also, I came into Solana 3 years ago. I was not there for the first 3-4 years of kind of the founding period of Solana, when Solana was seen very, very differently. So my experience as an operator today at the stage Solana is in is quite different. But then I'm curious, for you, you're not just an operator, but you're an engineer within that as well. Engineer turned founder, now turned an investor. So from your perspective, also is being an engineer in this industry, because there are so few people so far, right? Given our industry is relatively recent, right? We kind of haven't had enough cycles of talent for people to kind of build that track record like we have in Web 2, right? And do you also feel like being an engineer specifically, gives you a certain perspective in your investing role now?
So I feel like you'd expect my PhD is actually in distributed systems, which, by the way, was useless 20 years ago. Absolutely useless. It was academic pursuit. My dad has a PhD. My sister has a PhD. My brother-in-law has a PhD. Literally, my dad's dog is called Doc. So just saying that to be part of the family.
Hard family to be a part of.
Right. It's a pretty high standard. And by the way, if I was an early employee at Square. Instead of doing a PhD, if I had joined 2 years later, I would probably be a billionaire right now. And so I don't know if that trade-off for a PhD was actually the right one. But whatever, I have it. And you'd expect for the technical ability of the PhD of being able to judge consensus. I've been working on Byzantine fault tolerance for 20 years. I understand the mechanics of core consensus. I understand exactly what's going on. I've implemented much of it. You'd expect me to use a lot more of it on a daily basis. The reality is that you don't. The best use for your technical ability is actually be able to never be fooled by a founder. There is no founder that is sitting in front of you that can get something past you in the domain or the realm of distributed systems at its highest level. Of course, I'm not going to be the expert in parallel execution of Solana. And Anatoly sits here, and I'm sure he's going to come up with something about how the EVM is terrible. And I'm going to say, OK, cool, you're probably right. But at its highest level, it becomes very, very easy for me to judge what's real and who's real from who's not, and who can actually operate at the level of technical complexity and execution that is necessary. Especially because in our space, even more than the traditional equity space, we have engineers building products for engineers. And the typical standard for us is if you are a crypto protocol that doesn't have somebody that is actually deep in some technical domain, that's usually not a winning combo. So that's been the most useful part for me. In my free time, I do read papers. And in my free time, I try to create a position on all these consensus wars, which I find hilarious, right? But ultimately, I think it's really the judgment of whether the founder really has the technical ability that they're saying they do versus not. Especially because, let me just finish with something that every single one of my pitches that are either layer 1s, layer 2s, roll-up, restaking, whatever, it is constant that people say, oh, wow, you actually understand what's actually being said, which seems to me that apparently is not a common experience. And so lots of founders do these pitches, and they end up talking more about the narrative than they talk about the technology. And whenever they talk about technology, they just see blank stares, and they kind of eyes glaze over, people start snoring or something, I don't know. And I'm excited about, oh, no, tell me about how you're bit flipping, whatever. And so that's kind of fun, and I found it to be useful in that very narrow, very specific way.
So then, soon after you take a look at technical diligence, always as an investor, it comes to valuation, right? And for years now in this industry, we have some of the highest valuations out there. Pretty hard to justify, maybe only after AI today. Do you think it is justifiable long term, or do you think we're just all in for a very rude awakening over the long term?
So I struggle with this one. And for all of you there, this was actually supposed to be a question that I asked Lily because I don't have an answer for it. So this is a pretty good one.
Yeah, and I changed that. I was like, I would ask him instead.
So my instinct is the following. My instinct is that when we talk crypto, really we're talking about cryptography with economic incentives, right? In my mind, those are the two core pieces of the space that we've created. It is cryptographic mechanisms that are based on economic incentives that make these communities and these protocols work extremely well. And in that sense, one of the coolest things to point out, and something that Chris Dixon usually points out a lot, is that when we built traditional web, we didn't create any core economic incentives that were able to benefit from the network effects. I mean, maybe domains are the one outlier, or one of the biggest outliers, in which domain names, diogomonica.com, has some value. Or at least google.com does. And so those domains have value, and those are part of decentralized protocols. In crypto, anything that succeeds, we have, if you squint at it, created ways for the network effects to accrue value to something that is investable. And so as an investor right now, standing here in 2024, it's a lot more exciting to invest in core infrastructure and in a stack than it was in 99 or in 2000, because IP addresses didn't really accrue any value, and neither did anything on SMTP. And so right now, at least, I see this as the positive. There are network effects that accrue to tokens and to the underlying mechanisms, and so that's exciting as an investor because that's outsized return. On the other end, our entry prices are a lot higher. And lots of crypto companies, in theory, are equity companies, not token companies. And so those are going to have to go public at some point with traditional metrics that are just going to be compared to traditional financial metrics. And the funny part is that both token companies and equity companies in crypto have higher median valuations of entry. And so if the equity is going to be judged on an IPO at the same metrics as a traditional SaaS product, and I'm coming in 2x the price because it has crypto pixie dust spread all over it, then by definition, I'm going to underperform. And so that's the most narrow-minded view of the entry point valuation, is that could actually be a recipe for underperformance. And then finally, I may just share that one of the ways that we evaluate these tokens, and I think everybody does, is you look at market comparables, right? So the same way that I'm going to look at, if I'm looking at a payments company, I'm going to look at Stripe. Well, it's private, ignore it. I'm going to look at Square. I'm going to look at Adyen. I'm going to look at these payment companies to try to judge the net retention, the multiple of GPV divided by revenue, all of those different elements. In crypto, we do so by comparing with public tokens. Now, the hardest thing for me is when you compare, say, you're launching an Oracle, and you're going to compare it to Chainlink. And Chainlink is worth $20 billion. And you're looking at it, is this really my market comp? Because the float of this token is very low. And so how do you discount for floats? And it turns out that if you use normal mechanisms of discounted, like Black-Scholes and those models, you sort of discount it down to almost to zero. Because the float is so small, and the ability of selling these things on the open market is so small, that those public comparables become irrelevant by traditional metrics of puts, option pricing, or Black-Scholes, or whatever you want to use. And so you're stuck in this world of you're comparing it with public tokens, but you can't run really illiquidity discounts in the same way that you run it in the public markets. And on the equity side, you're comparing it with traditional tokens or traditional public markets companies, but you have the difficulty of you're coming in at way higher valuations. So I don't have a good answer. Do you have an instinct on how you look at these?
I think that what has been heavily favored by the investment community is the infrastructure narrative, because most of the high reputation organized capital that comes from professional allocators is typically coming from, for example, the US market, definitely #1 source of professional allocators into crypto. And because the US market also is typically, when it comes to innovation, oriented towards distributed systems innovation, the more sort of technical side, which is awesome in many ways. What I think results from that we don't necessarily fully appreciate, but is my opinion, probably a hot take, is I think that the incremental infrastructure coin, I think they're VC meme coins. And I know there's been a little bit of a debate recently that has been a little bit more prevalent in the Solana ecosystem, given the prevalence of meme coins in the Solana ecosystem. But I see a little bit of this dichotomy between meme coins being retail meme coins. We call them meme coins, or in Asia we call them meme coins. And then, to me, infrastructure coins, call it L2s, L3s these days as well, right? L3s, I think, are for sure infrastructure meme coins. And L2s, many of them as well, I consider to be VC meme coins. And so when I see it in that regard, I do think there are going to be some challenges with long-term value accrual, right? I think you've already seen that if you kind of look through the ecosystem, again, what we were saying earlier, sometimes the answers to what you're thinking about within your own operational perch are found elsewhere in the industry, is you've seen these kind of, let's call it application-specific deployment environments rotate and not find a use case and get archived. And I think you've seen that in probably the most successful application-specific infrastructure ecosystem right now, Cosmos, where you see chains get built, right, typically on an infrastructure narrative, but at least they're a little bit more forward infrastructure enabled or application-specific infrastructure with an application in mind. And some of them, many of them, really don't work out. And so I think that right now, that to me is a bit of an oversold narrative. Which is not to say that the opposite is necessarily true, right? You're not going to find me advocating for all 20,000 of the meme coins that are happening on a daily basis. But I think that, to me, I just think that there needs to be maybe a rebalancing. Instead of saying, this end, the right curve meme coins are all good, and the left curve meme coins are all scams. I think the truth is more nuanced than that.
I guess we could definitely make a point that all crypto, or most of crypto, has a huge meme component to it.
Yes, and I think because fundamentally I think crypto is just this, it's like the court jester, right? Money has always been predicated on social value. Gold, its value is predicated on social value, Lindy effect, all these types of things we've been talking about in crypto for a long time. And that's the truth behind the curtain. What we'd all like to believe is that money has value because there's something hard about it, right? But really, it's all social value, right? In a sense, to borrow from AI, but very different meaning, is attention is all you need, right? And so I think that really is, that's, the court jester in Shakespeare is, saying these things that no one really wants to pay attention to, but is actually sort of the core truth of the world, or of our industry, I think is really, to me, what the left curve meme coins are really kind of pointing out. Certainly not all of them, but some of them. Now, as we were backstage, we were debating one point, which I know you're very passionate about, which is, I'm not even going to ask the question, I'm just going to say what Diogo is very passionate about, which is longer vesting for token founders. So, Diogo.
It's not only a hot take, it's a very unpopular opinion. So let's see if this goes well for me. So my general opinion is the following. I don't think DeFi, and to a large extent a lot of crypto protocols, ever will truly be successful until the crypto founders have 4-year cliffs and 7-year vesting on their tokens. The reality is early liquidity. It is one of the main reasons for protocol abandonment. And there are tons of protocols that show a lot of promise in which the founders are absolutely not incentivized to do any hard things because they have $400 million in the bank now. And so I think that following a path that is tried and true in Silicon Valley, which is, call it whatever you want, which is 7-year median for an IPO, founders sell their preferred shares, which is 10% of the preferred shares on Series C or Series D. So usually around 4 years is the minimum that they would get liquidity. And then at the high end, 7 to 10 years would be what he would get all of the liquidity for all of their assets on a publicly traded company on an IPO. We should mirror that. And of course, it's very unpopular as an investor to say that, and it's very unpopular for a founder of crypto to receive it. But I do think that if we were able to do it and just do A/B testing between protocols that have this mechanism of incentive and protocols that don't, we would see long-term overperformance of the protocols in which the founders are actually committed for the long term. And I think that's just basic truth. It's hard to talk about it because everybody likes being rich very early and not have to wait for it. But I think it actually would be overperformance over the long term.
Really sounds spoken like an equity founder running a custody platform.
That's right. I'm extremely jealous of protocol founders. That is exactly what's happening here. But also as an allocator now. I'm an engineer that allocates capital. Capital needs to return multiples, and I would like your project to last for 20 years, not for 3 years, until you get $100 million off the table, and then you never care about this thing again. So I think there's also self-interest in the best way, capitalistic self-interest, which is I want to deploy on teams that are here for the long term. I mean, think about it this way. In traditional, every single venture fund that is a traditional venture fund always cares about a founder that goes the long route, goes for IPO, not for a flip, not for a sell. Early liquidity screws up all of it. And so it's kind of interesting for a space that was literally created on alignment of incentives, the core incentive, which is for the team to continue being there and do something, is not there. And so that's kind of ridiculous. And I think we should solve it if we could. And by the way, it has improved a lot. 7 years ago was very different than 5 years ago. That is very different than 3 years ago. That is very different than right now in terms of vesting, in terms of liquidity, in terms of it's public, whether the founders are selling or not, but I do think that that would be something that would make our space better.
That is a hot and pretty unpopular take, I think.
Very unpopular.
Very unpopular. Right. So now that's public, and next pitches you receive.
It's going to be interesting to see if somebody self-selects out from pitching me in case I go and try to convince them.
That might actually be a good self-selection.
Yeah.
Right?
Yeah, you're right.
You're just putting it out there. So let's see. So coming back to folks that have typically been locked up for a long time, professors, right? Professors, I mean, they're locked up for years into various grants with no liquidity, not even reputational liquidity for a long time. So you brought this up recently, which has been a little bit less on my radar, but professor coins, their resurgence. What do you think?
I think from a theoretical perspective, so professors, look, they've been researching all their lives, whatever corner of distributed systems, cryptography, security that they've been in. The main issue that I see right now is that anyone that has a tenured career can basically turn a paper into a protocol and thus can turn papers into tokens. And I don't think that's what we meant when we said we're in crypto, we're going to tokenize everything. I don't think we meant, research papers, we're going to tokenize them, literally wrap them in tokens.
Everything.
Yes, we're not going to tokenize everything. I don't think conference papers are going to be something that we want to tokenize. But it unfortunately is the case, and it's true. And they're very technically competent. So in a space that rewards technical competence, I think this is something that is happening. And I don't know if it's a good thing or a bad thing. Number one, I want the smartest, most accomplished people in the space, and that's happening. On the other end, the incentive for a professor that didn't make any money all over their career is to wrap it in a token and go out in style. And so that's also like a perverse incentive there. I think we're out of time. Let me just ask you a final question, which is, you talked about meme coins. Solana clearly is not a meme coin, and it has real-world utility. How are we using Solana here?
Well, thank you for asking. All of these wristbands that you have, when you're buying coffee, you're using Solana Pay. So everyone here has been a user of Solana today. And that's the way, in my opinion, I think Solana's, not just Solana, really crypto needs to be integrated into life, which is not, Solana tattooed on your forehead, or choose whatever you want to tattoo on your forehead, up to you. We're all equal opportunity here, but really it's about this technology making our lives more useful, or building things that are more useful to support our everyday lives and make our lives better. So.
And I think that's a wrap with a Solana Pay pitch. Thank you so much, Lily.
You need a wristband as well, Diogo.
Thank you, everyone.
All right. Thank you, Lily. Appreciate it. How you doing, Diogo?